Good afternoon, unit holders, investors of Manulife US REIT. Welcome to the dialogue session the SIAS has organized today. My name is Wan Chen, and I'll be your moderator for today. Mr. David Jarrow sends his apologies because he's feeling unwell. In fact, he's running a fever at this point in time, and we wish him safe recovery soon. Today we have a full suite of our management from Manulife REIT, and they'll be sharing with us their thoughts with regards to the three resolutions that hopefully will be passed at the EGM on the 14th of December, and that's next week. They'll be sharing with us their thoughts and plans for the future of Manulife REIT. And certainly, as part of this discussion today, we'll be fielding questions from the floor. Today, we have, first and foremost, we have Mr. Mark Feliciano, the chairman of Manulife REIT. We also have Mr. Trip Grant, the CEO of Manulife REIT. Trip will be presenting soon after my introduction in terms of what the plans are with regards to the recapitalization of Manulife REIT, and also the three resolutions that hopefully will be passed on the 14th of December. Next, we have with us Ms. Caroline Fong, Deputy CEO, Chief Investor Relations Officer, and also our Sustainability Head at Manulife REIT. Next, we have Mr. Robert Wong, CFO at Manulife REIT. And last but not least, Mr. Patrick Brown, who's in New York at this point in time. In fact, he's based in New York. Patrick is our Chief Investment Officer from Manulife REIT. So thank you, Patrick, for coming in at such a late night today. So like what I said, Trip will be doing a quick presentation in terms of his plans, his thoughts for the organization. And thereafter, we'll be happy to take the questions from the floor. We have about 50 submitted questions from the unit holders prior to this dialogue session. We have summarized the questions, and definitely the management team from Manulife REIT will be answering these questions. I know we have only an hour. We may have a bit of a stretch time, but Mark has to leave by 1:30, and we probably do have a hard stop at 1:30, even though the presentation dialogue session has been scheduled for 1 hour. But be rest assured that the questions will be answered, even though we may not have the time. But management, together with SIAS, will go through the questions, and we'll make sure those questions are answered prior to the EGM on the 14th of December. So without much delay, let's now bring on Trip, who will be doing a short presentation on his thoughts, the plans, and the resolution for the 14th of December. Over to you, Trip.
Great, thank you very much, and thanks everybody for joining us this afternoon. I think that, as we all know, back in July, we informed the market about a decline in the valuations of our portfolio that resulted in our unencumbered gearing ratio exceeding the 60% level, and the subsequent breach of the covenants of our loan agreements. And since that time, we've been in negotiation with our lenders alongside our sponsor to determine a path forward, and we're here to tell you today, obviously, about that recapitalization plan. This has been an extremely complicated exercise. Negotiating and finding agreement with more than a dozen lenders has been challenging. But despite the complexity and the challenges in aligning the interests, all the parties have really worked night and day to get this across the line. And while it may have seemed like a long period of time without having heard much about what was happening behind the scenes, we're still pleased with the speed that we're able to come to an agreement on a path forward, and the speed with which we can begin to execute this plan now. So I'll go into the presentation. I'll cover the mechanics of the recapitalization plan, touch on some of the details, but really we want to give ourselves time to answer questions. I know that there's been a lot of uncertainty, a lot of questions out there in the market. We've seen the chatter. We've been talking to investors over the last week and a half now, and obviously getting a lot of similar questions that we feel like we can can answer for folks. And so that's what we're here for today. And we're looking forward to talking to you about this. So I'll go ahead and jump into the presentation here. The recapitalization plan is essentially made up of two distinct parts. The first part and the most initial phase of this will be a $285 million of funding, which will be used to pay down our existing lenders on a pari passu basis. The $285 million will come from three different sources. The first will be the divestment of our Park Place asset in Chandler, Arizona. We'll be selling that to the sponsor for $98.7 million. This does represent the higher of two valuations that were carried out on the property. The $98.7 million is the value of the asset at our June 30th. We had a subsequent appraisal done, which came in at $94 million, but the sponsor will be buying it at the higher of those two valuations. The second piece of this will be the $137 million of financing proceeds, a loan from our lender. We'll get into a bit more detail about the terms of that loan in just a moment. And lastly, we'll be utilizing $50 million of cash from our balance sheet. So after the initial $285 million is used to pay down the existing lenders, we kind of go into the second phase of this, which will really focus on asset dispositions and what we'll be doing with the distributions that will be retained. First of all, the asset dispositions are a key component of this. We're looking to raise up to $328 million in asset dispositions over the next 2 years. And in addition to the retained distributions, using that liquidity to both continue to pay down debt further, as well as fund CapEx on the existing properties, the properties that we're going to maintain and keep, and try to optimize the portfolio to capture as much of the upside as we can when the office market begins to recover here over the next 2 years. A key piece of this is going to be the disposition mandate, and we'll touch on this in a slide here in just a moment. But really, the disposition mandate is something we'll be asking unit holders for permission to sell these assets and to be able to be a competitive seller in the market. And I'll touch on the mechanics of that disposition mandate here in just a moment. You know, I think we're all aware of the challenges that we faced in the environment that we've been dealing with in the U.S. Not only are we going through kind of a once-in-a-generation change about, you know, how Americans work, where they work, how they use the office, but that kind of very, very fundamental change in our sector, you know, collided with the financial headwinds in the U.S. economy as well, in terms of the rising interest rates. The Fed obviously battling inflation has driven the interest rates higher at a very, very accelerated pace. And all these together have really had a big impact on the valuations of U.S. office. The valuation decline that we've seen in our portfolio over the past year has been roughly in line with what we've seen in other indices of U.S. office. And one of the indices that we follow closely is the NCREIF index, which is down 21.1% year over year, which shows that our valuation declines have not been an anomaly. The other important piece of this to note is that the rising interest rates and the uncertainty out there has really taken lenders out of the market for U.S. office, with limited financing options, both for owners trying to refinance their upcoming debt maturities, as well as buyers who are looking to purchase office. It's really difficult to find debt right now. As a result, office transactions, sales transactions have fallen 69% year over year. And this is just a backdrop of what's really been driving a lot of these valuation declines and the challenges of finding liquidity in U.S. office. Now, over the past year, we've tried several different things before we got to this point. We have attempted asset dispositions. We've explored dispositions on several of our assets over the last 18 months. In 2 different cases, we had buyers engaged with us, and they could not find financing. And as a result of that, those asset dispositions were not carried forward. We've also looked at the potential of equity fundraising. Our market cap and just a lack of appetite on the part of banks to underwrite these equity fundraisings has made that difficult to date. We'll continue to monitor that, and at some point that will be a part of the solution overall in getting us back to a business as usual kind of situation. But for right now, and in the past 12 months, it's been a difficult task to undertake. We continue with our strategic review. We're still engaged with Citi. We do have a number of parties that are still interested in looking at maybe the potential of being strategic partners, but they're really waiting to see the outcome of this plan. There's a lot of uncertainty right now, both in terms of the breach of our loan covenants and the agreement that we'll come to with our lenders. And so a key component of why we want to get this recapitalization plan done is so that we can re-engage the parties on potential strategic transactions. We've also looked at potential mergers, a lot of complexity there that doesn't really address all of the needs that we have in terms of our leverage. But lastly, and this is a really important piece, there aren't a lot of external lenders out there for us, either at the property level or at the REIT level. There's just not a lot of credit available in the market right now. Our borrowing options are very limited to address both the maturities, as well as the liquidity needs that we have. And so that's been a key component of this plan and why the sponsor loan is so important to this. So overall, just given the fact that we have looked at a lot of different options and a lot of different alternatives, we feel that this recapitalization plan offers really the best solution, potentially the only solution that we have now to continue moving forward in executing this plan. Now, what do we get in exchange for paying down the lenders? Well, the first and most important piece is that the lenders agree to waive the past and existing breaches. This puts us back in control, puts us back in a place where we can begin executing this plan. The second piece of this is a relaxation of the financial covenants, recognizing that there could be further downward pressure on U.S. office valuations. The lenders have agreed to relax the gearing limit in the ICR to give us the space so that we will not, be breaching the new loan covenants. They've given us the space to be able to operate in and absorb any shocks that may come over the course of the next 2 years. And lastly, and most importantly, they're giving us time. We're extending all of the loan facilities by 1 year. In other words, the $181 million of debt maturities that we had coming up in 2024, not only are those debts being paid down, but their maturity dates are being extended by 1 year. So we don't have any maturities now coming up in 2024. And the first debt maturities we have in May of 2025 are going to be reduced given the amount of debt that we're paying down. And really what this does is it gives us the time and the runway that we need to execute the asset dispositions and focus on optimizing our portfolio. Another key point to keep in mind here as well, the lenders are extending those loans by a year at the same rates and in the same terms that we're currently at. So we're able to take what we feel is currently under market rate debt and extend that by 1 year. And that's a valuable thing. Now, taking a look at the sponsor loan terms, as I mentioned, it's a $137 million loan with a 6-year term. The current pay on that interest is going to be 7.25%, but with an exit premium at maturity that brings the effective interest rate to about 10% per annum. Now, recognizing that this is where a lot of the questions are going to come from, obviously that number is higher than our current cost of borrowing. But that is where the market is right now for debt, for either at the property level or at the REIT level. And the IFA has concurred on that with the comparables that they were able to find, that this 10% per annum rate falls reasonably within the range of the comparables of what our other options would be if we were able to find them at all. And as a result, the IFA has determined that these are on normal commercial terms and not prejudicial to the interest of the REIT or the unit holders. Again, I know that we have a lot of questions about this, and we'll be answering more in the Q&A session. But we're glad to answer any questions you have about this. The other key piece here, as I mentioned, is this disposition mandate. And really the idea is, given that the asset dispositions are a key part of this recapitalization process, and given how we've talked about how asset sales and real estate office in particular is really difficult to sell and transact at the moment, given the lack of liquidity in the debt markets. We do want to be able to be in a position to act quickly and decisively, though, when the market does stabilize and return when transactions begin to happen. And really, we want to be able not only to be as competitive and nimble a seller as possible, but we want to be able to maximize proceeds as the best we can on these asset sales. And the way that these transactions are going to work in the U.S. is when we do put a property out to market, buyers will come, we'll get offers. Under the normal circumstances and under a normal process, we would need to go back for an EGM for each individual asset sale that we want to undertake. We feel that that's not only going to make us a much less competitive seller, but it could reduce the amount of proceeds that we can get for these assets at the time of sale. And that's largely because buyers in the U.S. are not going to want to deal with a seller who has to go back to their unit holders for approval, and the time and the cost of all that. And the buyers that are willing to go through that process with you are likely to give you a lower price to compensate themselves for the transaction risk. And so we just feel like in order to be the most competitive seller and to be able to maximize the proceeds for our unit holders, being able to be nimble and quick and meet the buyers on their timeline in the U.S. will make us more competitive. Now, the way that this will work is that the trustee would commission an independent valuation at the time of sale. So when we get an offer in, we would then commission an independent appraisal, and we would not be able to sell at less than a 10% discount to that independent valuation at the time of the sale. The other important part of this, and I'll cover this on the next slide, is how we've prioritized assets for sale in terms of the first assets we're going to be targeting when we feel it's the time to move forward with this. Another important thing to point out is that the disposition mandate would expire either at the end of 2025 or at the point when we execute $328.7 million of sales. In other words, this disposition mandate doesn't give us carte blanche to sell the entire portfolio. We can only sell up to $328 million worth of proceeds, and then we would need to come back to unit holders for approval of any more sales above that. The last piece, and this is important as well, you'll hear this term, early reinstatement conditions. Essentially, if we're able to get our gearing back to within the MAS guidelines, these will be what they call early reinstatement conditions. And not only would the disposition mandate roll off at that point, but we would also be able to be in a position to begin resuming distributions. We'd be back to kind of a business as usual situation under this early reinstatement conditions as well. So when we look at the assets in our portfolio, we conducted an analysis to kind of figure out how we were going to prioritize which assets we want to target first for sale. And really what we're looking at here is the potential financial return that we're going to be able to get from each of these assets and the factors that kind of play into that. The first factor is occupancy risk. What we're really looking at here is how competitive is an asset going to be in attracting demand in the future. And this can be made up of a couple different things. One, it can be about the submarket where a property is located, how much supply is online in that submarket, the strength of that submarket, whether tenants are showing an interest in being in that submarket. The second piece of this obviously is the building itself. How competitive is your building? How attractive is it to tenants? What's the age of that building? And how competitive are you going to be to attract that demand going forward? The second piece of this is CapEx requirements, and really what we're looking at here are which assets are going to require a lot of capital in the future, whether it's to lease up, to improve the buildings to a competitive state, ongoing maintenance at each of the buildings, given the age of some of these assets. Those CapEx requirements, given our liquidity, our need to focus really on liquidity right now, is going to be pretty key. And then the two of these combine together to kind of give us a view towards the total return potential. The money that we do need to put into these assets, which assets are going to give us the return, both in terms of increased rents, increased valuations, and which assets do we feel have the highest potential financial return from that investment. And we've ranked them in accordance to tranche 1, tranche 2, and tranche 3. The tranche 1 assets are really the assets we're going to focus on first in trying to sell. And the tranche 3 assets are the ones that we feel over the long term that we would like to be able to hold on to. They're largely our newer, highest quality in terms of the building quality assets in submarkets that we think are going to see value recovery as well. Looking at the financial impacts, I won't go into the details on this slide, but obviously, over time as we sell assets and pay down debt, both our gross borrowings and our total assets will be reduced. The pro forma that we have is that our aggregate leverage would go from about 56.5% down to about 49.4% at the end of all these steps. And our NAV per unit would have a corresponding decline from about 40 cents to about 34 cents per unit. So really, in summary, I mean, what this transaction is bringing to the unit holders and to the REIT is most importantly, the lenders are agreeing to waive the breach and step back and give us control of the REIT and be able to move forward and execute this, as well as giving us the time that we need to weather the storm in the U.S. office market, look for improved market conditions, and execute this plan. The disposition mandate gives us the flexibility to be a competitive seller and really maximize the proceeds on behalf of the unit holders, and both to get the liquidity that we need to pay down debt and fund CapEx and strengthen the portfolio. And lastly, and perhaps most importantly, the recapitalization plan gives us clarity. It gives clarity to potential equity partners. It also gives us clarity on the amount of equity that we would need to raise to bring our gearing down to an optimal level, and be in a position to resume distributions and implement a go-forward strategy for the REIT to help put us back on the road to recovery and growth again. We'll go to the next to last slide here. Looking at the resolutions that we're going to be putting through in the EGM here. There's 3 resolutions. The first resolution is about the divestment of the Park Place asset. Since it's an interested party transaction, we need unit holder approval to sell this asset to the sponsor. Likewise, resolution 2 would be based around the sponsored loan. And the third resolution would be this disposition mandate. The important thing to note here is that all 3 of these resolutions are interconditional. It was part of the agreement that we came to with the lenders that all 3 of these resolutions would need to pass in order for this recapitalization plan to be implemented. If all 3 resolutions are approved by our unit holders, the lenders will grant the waiver, relax those financial covenants, and allow us to begin executing this recapitalization plan. If for any reason any of these 3 resolutions are not voted or are voted down, the existing facilities will remain in breach, and the lenders will maintain control of the situation. They'll have the right to accelerate all the loans immediately, and would have the right as well to exercise their remedy to begin a liquidation of the portfolio at the current prices, which we strongly feel that this is not in the best interest of our unit holders, not in the best interest of the REIT. And we want to avoid this outcome. And so we believe that the recapitalization plan that we've presented here does give us essentially the only path that we have to continue moving forward. The last slide just shows the dates. Here we are. We're engaged with you today here. We've been engaged with investors over the last week. And the important thing to note is that the EGM is scheduled for December 14th. But the last date for unit holders who are going to be voting via proxy will be on December 11th, and it's important for all of our unit holders to have their votes in by that time. So I'll go ahead and stop here. That kind of ends our prepared remarks. I think that we'll open ourselves up for questions now. I think you're on mute.
Thanks very much for the presentation, Trip. Very informative, very clear. I think the options available for unit holders are certainly I guess what would you characterize, Trip, if I can start the questions and answers? We've got quite a few questions. In fact, we have 31 questions on the floor right now, and we will try to answer all of them. If not, we'll answer them post the dialogue session. But Trip, maybe you can characterize for the unit holders, how would you describe the situation right now? Is it the no hope? Is it the dire straits? Is there a good plan moving forward? What should unit holders feel at this point in time? If I can kick off the questions.
Yeah, well, I mean, we obviously believe that there's hope here. I think all the parties involved here feel that we're involved in the recapitalization and negotiations here, including the lenders, feel that there is hope, which is the reason that they've given us the time to kind of weather the storm and the time to execute this plan. I think that if there was no hope, there wouldn't be this plan, and I don't think the lenders would have given us the 2 years, of runway here to execute this if we didn't all believe that there was light at the end of the tunnel. Our work is cut out for us. Let's not sugarcoat this. There's going to be a lot of hard work to do after this recapitalization plan. If this recapitalization plan is approved by unit holders, there's still a lot for us to do. And over the next 2 years, we'll be busy, and we'll have a lot of things that we have to execute and pull off. But I do think that we see a path here. Not only we've talked about this kind of coming in 3 phases. We need to stabilize the situation. We need to position ourselves for recovery, and then look at how we're going to grow from there. So stabilization, recovery, and growth is how you're going to hear us categorize the different steps. Stabilization is the most important part here right now. We have to have this in order to stay alive. But I do think that from here out, once we've achieved this, and if we can get unit holder approval for this recapitalization plan, we begin the recovery. And really, some of this is going to depend on the market and things that are out of our control. But a lot of this is going to be, within our control in terms of how we are able to kind of get back to the basics of real estate. Use our dollars as wisely as we can to strengthen our portfolio and focus on value maximization, both for unit holders and increasing the income at those existing properties, and looking to where we can begin to get to a point where we can grow DPU again here in the future. So I think that all of us believe that there's a path forward here, including the lenders. And we just need the ability and the space to execute this plan.
And if I can be so bold to ask you, Trip, why should unit holders vote? I mean, hope is nice, but what happens if things don't fall in place? What happens if valuation goes further south?
Yeah, I think we're all going into this eyes wide open, including the lenders. The lenders have expressed again that they do think that this recapitalization plan will work. If unforeseen, we're still in an uncertain environment, right? There are still a lot of uncertainties out in the world. If we continue to see volatility, if we continue to see different things happen, black swan events happening in the world, I think that we're going to have to come back and get all the parties re-engaged here and take a look at where we are, and just go into this eyes wide open. I think that we can't rely on just hope. As I mentioned, there are some things that are out of our control in terms of what happens in the markets, where inflation goes. But I do think that we're seeing a lot of encouraging signs there about certain things in the financial markets beginning to stabilize. But I think that what we can all do right now is not just rely on hope, but rely on executing the parts of the business plan that we have control over. And again, that largely for us goes back to focusing our investments and focusing our capital on the assets that we think that we're going to be able to see rental growth and valuation growth, and really focusing our fire there as best we can. And not relying on hope, but working really, really hard to affect the best outcome we can at the asset level.
Thanks, Trip. And if I can summarize that, hope is nice. Hope is good to have, especially this time of the year when we are hoping for a new year in 2024. But you believe that you have solid plans, and execution is key, I guess, to everything. And management is certainly very ready to do that. That's
correct. And I think one of the important things to point out here too, and I'm sure this will come up later on, because we've seen questions about lessons that have been learned over the past 2 years, and what could be different now than was different in the past. A couple things. First of all, I think that we've come to a working arrangement with our sponsor that I feel is probably stronger now than it's ever been. Mark coming onto our board. Mark is the global head of real estate for Manulife. We have all of the resources really focused from the Manulife real estate platform on this REIT now. And there's a very close working relationship now, more symbiotic than we've had before, about the relationship with Manulife and the role of the sponsor in helping us execute the real estate strategy. And I would say that the other important part of this is that now that we're getting out of a lower interest rate environment, you're going back to more basic real estate. I mean, you've got real estate people on this team now There's more than 75 years of real estate experience in this room at the moment now. And we're back to a place where real estate people can do the real estate things that we've wanted to get done in this portfolio for a long time. It's no longer just a game of borrowing at the lowest possible cost and leveraging up. And it's back to fundamental real estate. And you've got real estate people on this team now, and you've got a support of a real estate organization behind us now like we've never had. And I think those things combined together are going to put us in a better position to see a better outcome in terms of the performance of our real estate and how that plays to the underlying financial fundamentals of the REIT.
Thanks, Trip. Let's give you a break right now. I think after the presentation and answering the first few questions, let's give you a break. And maybe since you mentioned Mark, let's go to Mark, Chairman of Manulife REIT. And thanks very much, Mark, for coming on the dialogue session today. Maybe I can ask you, Mark, from the point of view of the sponsor, why do you believe in Manulife REIT?
Well, look, it goes back to the days of the IPO. There are a lot of factors, including looking for a listing in Singapore as opposed to a listing in the United States, or creating a structure such as a non-traded REIT in the US. The Singapore market is very efficient, both in terms of equity capital markets and the debt capital markets. Hence, you saw over a few years ago that this team moved the property financing from the mortgage market in the US to the unsecured market here in Singapore. But the bottom line is that we have a fairly sizable global real estate platform, and what we thought but still do today, believe that investing in real estate, including office, is still an opportunity for unit holders. That being said, as Trip noted, the property markets all over the world are cyclical. The capital markets associated with the property markets are also cyclical. They go through typically 4 phases. We're currently in the contraction phase. We should be following that up with what we call the recovery phase, and ultimately into growth, and eventually, once again, a slowdown. These cycles tend to be anywhere from the short end 6 years to maybe as long as 12 to 14 years, if you go back historically. But coming back to your question and comment to Trip around, do we operate off hope? We say hope is just a false certificate sometimes here in the United States. What we do need to execute. I think there's a lot of things that we are doing today, including this as a starting point. This is only a starting point for all those who are on the call. This is just the beginning of what we call stabilization. And throughout the year as we execute, and over the next 2 years as we execute, we hope to create a recovery for the REIT, but also to take advantage of what will likely be a recovery in the U.S. office property market over the next couple of years, and move into growth. So we're committed. We think there from here, should we receive approvals by all lenders and unit holders, that there is a better story or light at the end of the tunnel, so to speak. But I want to emphasize that this is only the starting point. So we're not committed to this just simply to deal with the current breach or the EOD. We're committed to see this all the way through. And so putting it back on you a little bit, you don't need to rely on my words or any sort of hope that might be generated through my words or Trip's words. One of the alignment that the lenders look for with the sponsor is to be aligned with them also as a lender. But most importantly, that tangibly we're in this no matter what through at least the next 6 years. As all of you may know or do know, that the sponsor loan is 6-year in term. In order to get paid off, and we get paid off last, we're going to have to at least execute all the way through the next 6 years. So don't need to rely on hope in terms of what we need to do from here. We're committed. If you want to take the skeptical view, which I don't blame any of you, you could say we're on the hook, so to speak. See this through the next 6 years in terms of execution.
Thanks for that, Mark. One more question from you before we go over to Caroline. Then we'll go over to Patrick Brown. So Caroline, there's a question on sustainability from Tusa Kanti Poda that the unit holder says that Manulife REIT is not sustainable. So maybe you can think about the answer to that. And then for Patrick, a quick question on valuation. Will the market go further south? What's the prognosis for the market? So Mark, there's been one of the questions is saying that management REIT, Manulife REIT is slow, not able to react fast enough. Any thoughts on that?
So let me address it this way. Unless you score 100% on a test, even a 99% or 95%, we can always do better.
Yep.
Particularly with the benefit of hindsight. Without getting into debate too much, whether it was slow to the detriment of or not fast enough. Again, in the vein of moving forward, when you think about what we need to do post event of default and when that began in mid-July, or when that was announced in mid-July through today, to get all 12 lenders plus the sponsor lender and its credit committee, so 13 lenders essentially, to move with speed in this amount of time, because I've done a lot of restructurings over my 31-year career. That was certainly a lot more than the $1 billion plus of the existing debt. You typically don't move this fast, particularly when you need 100% consent or approval from all lenders. So on that point, we are moving faster. We're moving better. We need to do a lot of things better and tighter as it relates to execution. Again, this is just the starting point. Doesn't mean it's over. Should we receive approvals? We now need to go out and execute, and we're going to execute around the capital market strategy, an asset level strategy, and ultimately a real proactive portfolio strategy. On that part, coming back to your earlier question, Trip, or his comment around what we could do better, irrespective of whether you're facing stress or distress from debt, we need to have an active portfolio strategy. What that means is actively buying, but also actively selling, particularly those assets where we think we've already maximized the value. It's just getting the greatest return on the unit holder's capital or equity by culling the portfolio, redeploying into the right CapEx projects for the long-term strategic assets, but also for redeploying into better opportunities. And by the way, this is why we emphasize this is only the starting point. As we get through stabilization, recovery, and ultimately growth, the next 2 to 3, maybe 4 years are going to be some of the best vintage years when it comes to property investing in the United States, and probably for office. There are a lot of naysayers on office today, but there's a lot of naysayers that tend to happen when it's almost like the public equity markets in a way. A lot of piling on, either being the ultimate bulls or piling on and being the ultimate bears. But things tend to reach an equilibrium. Then when they do, that's when I think you'll start to see office in particular begin to recover.
Thanks so much, Mark. Over to you, Caroline. Then we go over to Patrick to talk about the market valuation, properties. What's your prognosis moving forward? Will the covenants be breached again? So Caroline, there's a question on sustainability that says that it appears that Manulife REIT is not sustainable. Can I hear from you your sustainability strategy and how that is put into place to keep Manulife going?
Sure. Thanks, Wan Chen. I think the question, if I don't wear my sustainability hat, I think it's more a general question. How far the REIT has come, and why should investors think that we could still survive and carry on? I think that's the million-dollar question, if I may. The last 1 year has been extremely challenging.
Yep.
I'm sure it's extremely even more painful for all the unit holders that we have. And having been with the REIT since IPO, this is something that is unfortunate, and we do not want this upon anyone And what we have been going through in the last 3 months, 6 months with the lenders has been very, very challenging. So if I may just address the question in a different way. If you asked me 3 months ago, will we still be here today? I'm not sure. Because it's the first time, I think, in a history that we are faced with 12 lenders. And these 12 lenders literally have a right over the entire REIT, all equity holders and everything else. And these 12 lenders have different size in their loan. Some of them from 10, 15 million, all the way to 100 over 200 million. Everyone has a different maturity tenure. Some expire next year, some expire in 27 and beyond. And to get all 12 to agree that pulling the plug is not ideal, that was a great hurdle to cross. And I think for all the investors with us today, I hope you don't have investments in some of the REITs that didn't come so far. But just in the last 2 months or so, there were REITs that didn't come so far. So we don't take for granted that it's a given that we would have today. So I mean, in short, even for me talking to all of you today, it's not given. And of course, there has been a lot of questions whether was liquidation a better option. And to give you a bit of color, if the 12 lenders don't think that that is the right option to go down, there will be reasons why. In terms of valuation, I think Trip has shared about the US market on how challenging it is. We have got offers through our strategic review in the last 1 year on the sale of the entire portfolio. And what I can share is, even at the offers that came through, first of all, we're not sure if they can pull it off because you need to come out with cash as the US market is quite closed. There is no lending. And some of the offers that came forth has been rejected because unit holders may not get what they are hoping for, or even far from where we are today, if I may. So which is why when we explore all options, I think the resolve with the lenders where we are today has been in what we can say a win, just because even last week or so, it was not sure that any banks could have pulled the plug. So I think if you talk about the sustainability and how we can survive, I think we are comforted in the sense that even with 12 lenders having different agenda, we have REITs, as we speak now, are going through difficulties, have just made an announcement on their gearing level, and we'll be facing some of the challenges that we have. And I think depending on how the sponsor steps in and how the lenders are willing to even cooperate, there may be more headwinds ahead. But if you look at where we are today, the reason why some of the lenders are even still with us, allowing to extend a loan is not it's not a small ask, right? I mean, why should you, if you are due tomorrow, extend for 1 year? Manulife has stepped in this round, and I can say it because I have been with the REIT for one of the longest. Manulife has stepped in, and a lot of strings were pulled on a very high level to get us to where we are today. So we believe that with that and with the sponsor support, and we have also been informed that our sponsor, Mark, who is based in Chicago, will be relocating to Singapore, not just to see us through the next 2 years, but as the global head of real estate, his agenda and to grow the real estate platform in Asia and in US will be good for unit holders as we stabilize ourselves and then recover and grow. So, I mean, with that, I hope that gives a bit more, I would say, color. And I'll just urge unit holders to I mean, you have been really patient, and we don't take that for granted. We're really thankful for that. To give the sponsor management team a chance to go through the recap plan and let things happen and see how the market will evolve, and hopefully the rates taper and we have a little bit more, I would say, reprieve and can breathe a little bit better as we get through that. Yeah.
Thanks, Caroline, and we're glad that Mark is relocating from Chicago to Singapore to help the local economy and the real estate market here.
Well, it's partly to avoid the very cold winter in Chicago as well, and come to beautiful Singapore.
Thank you, Mark. We over to Patrick, and then we'll go over to Robert. Robert, I'll be asking you questions on the distribution, that there's a moratorium until 2025. So and also managers expenses. How do we manage expenses? There's quite a few questions on that. So from a fellow bean counter, I'm a bean counter too. No offense, Robert, but what are your thoughts on distribution and management expenses? But back to Patrick. Patrick, where do you see the market going? Is it going further south? Are we going to breach covenant again?
Yeah, no, it's a good question, and happy to answer. So I would, just to set the table a little bit, if you think about it, Must has experienced approximately a 25% valuation decline over the last 18 months or so. First, a 10.9% decline at year-end 2022, and then a 14.6% decline at mid-year. And there were some declines in the previous years. So net, we've had some pretty drastic declines in the portfolio over the last, call it 2+ years. And in comparison's sake, the U.S. market, if you look at the NCREIF Property Index, which is a very large office index in the U.S. with over $200 billion of office assets being valued, fair market value on a appraised basis like we do, that's also down over the last, call it 12 to 18 months, about 20%. And so we have had more punitive valuation declines relative to the overall market. I do think on a go-forward basis that there is likely to continue to be some pressure on valuation, but I think consensus view is that the pace of valuations and the range is likely to slow. And I don't think we expect that we're going to have consistent year-on-year 15%, 20% valuation declines. I think as evidence of that, the 10-year Treasury in the U.S. was north of 5% earlier, or around 5% earlier this year, and it's now down about 4.2. And there's some varying views about the Fed may have stabilized rates and may even be on a rate cutting path. I'm not forecasting that or predicting that, but any stability there, I think, relieves the pressure valve a little bit on valuations. So I do think that I'm hopeful, to borrow a word that we've used a few times during this meeting, that we may have seen the most harsh valuation declines thus far, and that anything that comes hereafter is less harsh. But I do think that there's probably some continued downward pressure. But I do think the last thing I would say on this is that we talked about the tranche 1, tranche 2, tranche 3 assets. And one of the reasons we think the tranche 1 assets are probably assets that we feel are better off to be sold is there's occupancy pressure, there's capex pressure, there's low economic return, and those assets over the fullness of time probably face greater valuation decline as well as less valuation upside. And if we are successful in selling those assets, I think the portfolio that we'll remain with has greater upside in a total return and a valuation perspective, as well as an income perspective in the coming years, which will provide us with the upside for the unit holders as we execute business plans.
Thanks very much, Patrick, for that rundown of the market. There's a few questions also on the selection of the assets to be sold. Maybe you can shed some light on that, Patrick.
Sure. Yeah. No. As I said, we've carved them up into tranche 1, tranche 2, and tranche 3 assets. And tranche 3 assets are being the assets that I think over the near, medium, and long term we have the most conviction about in terms of its return potential. So we think that those are going to be value accretive to unit holders, and the tranche 1 assets are on the other end of the spectrum, and we feel that they're going to come with occupancy pressure, both in terms of existing tenants in those buildings who may be either downsizing or vacating, combined with limited tenant demand in those particular submarkets for that particular product at this moment in time. So it's going to be a longer road to recovery on an occupancy front. The assets also happen to come with fairly meaningful capex pressure that is in the form of both leasing related capital that's needed just to get things leased back up when tenants come along, but also, you know, what we call deferred maintenance, which may be non-leasing related and could be the replacement of a roof or a mechanical system of some sort, that will be, you know, necessary to be incurred at those buildings. It doesn't necessarily come with, you know, a value pop for spending that. For example, if you replace the roof, it doesn't necessarily mean that tenants are going to pay you a higher rent. So it's sort of just, you know, it's the cost of doing business, so to speak. So we want to avoid where there's heavy CapEx spend without a value pop correspondence coming from that. And then lastly, you know, on the return potential of the tranche one assets, we just felt that they're the least attractive to the unit holders, and you know, they dilute the overall portfolio average on a go forward basis. And so, you know, and that's even at you know, the current valuation marks or the strike price of the 328. We just don't feel that the corresponding go forward return is in the best interest of the unit holders. So it's a hold sell decision. You know, with each day that you're holding something, you're essentially buying it, and we just feel that at those prices, it's better to move them and unleash ourselves of the burden of the heavy CapEx and the occupancy pressure, and focus on the assets that are going to be higher return, higher income generation potential, less CapEx, and more tenant demand, such that occupancy risk is lower.
And do you think in terms of the asset sale, Patrick, are we potentially killing any golden goose?
No, I don't. I don't think that if we start to sell tranche one assets, we will have, you know, sold a quote unquote golden goose that we would have come back to regret 2, 3, 4, 5 years down the line. I think these are the right dispositions.
Thanks for that, Mark. Sorry, Patrick. Maybe over to you, Robert. From your CFO point of view, are there room to cut expenses? As one of the questions, even talk about should we cut the salaries of management? Then on the flip side, is really distribution is going to be halted until 2025. What's your view on that? Can it be brought forward earlier?
Sure. I'll address the first question first about you know, minimizing the expenses for the REIT. In fact, it's just, we've been doing this for a couple of years now, you know, in terms of prioritizing where we spend and cutting down on expenses generally. I think in some way, Patrick has shared about, you know, when it comes to prioritizing where we spend on CapEx, we have cut back a lot on non-essential CapEx spending, right? And in fact, we look a lot closely in the past 2 years on leasing deals that's presented to us, especially those that involve a lot of square footage in the particular buildings. We basically suppress anything that is not going to be value add. Value add in the sense that the income generated from a lease for the lease period may be kind of achieving a yield that's lower than cost of debt, or that it doesn't kind of translate into a valuation increase for a property. All those ones are kind of rejected and suppressed, and including deferring any CapEx spending. In fact, we've been managing that quite well, in a sense. That's why back in year-end 2022, we're still able to keep the gearing down below 50%, just a tad bit above 50%, not breaching the MAS gearing limit. But the mid-year valuation obviously came unexpected, in the sense that it gone a lot wider, in excess of 14% plus deviations in valuation decrease. So that kind of causes the breach the unencumbering gearing ratios under the financial covenants, right? Hence, we have this exercise to have dialogue with a dozen of lenders to try to have these workable solutions, which basically includes tranche one asset sale, which is our assets that we identify as non-core, to try to reduce gearing. The park-based dispositions, 50 million from the cash flows from the REIT to pay down the debt to get it down below 50. There's a lot more work to do. I mean, we have to sell probably a bit more assets and equity fundraising at some point in time next year, right? To kind of reset the gearing down to a certain level so that we can get out of this imposed situation by the lenders. Obviously, the lenders will not permit a borrower to start distributions until they could see that we can reduce the gearing down to a meaningful level. And what is agreed is essentially the MAS gearing guidance of 50% if our ICR is 2.5 times, or 45%, if our ICR is below 2.5 times. So we're trying to get our gearing down ideally around the 40% mark, which is where we think is a more manageable approach. And also along the way, in terms of cost cutting, we have a lot of dialogue with the sponsors, and sponsors has been very supportive of the REIT in terms of waiving a lot of fees, absorbing some of the transaction costs. For example, the tennis bond disposition fee is waived, Park Place disposition fee is waived, and along the way, some other costs that may not be as visible to the market. The sponsors is behind the REIT all along.
And how about the distribution, Robert? Any thoughts of that? Any chance of that being brought forward before 2025?
Yeah, so as I mentioned, the distribution could only be reinstated once we're able to get the gearing down to the 50 or 45% gearing limit.
Yeah, I mean,
I think, sorry, I think Mark wanted to say something.
yeah, and maybe to follow up on your question, I think you specifically asked about any view in terms of cutting expenses, as in perhaps the comp of the management team. Maybe another way to address it is for the last year and a half, with respect to, or the last 2 semi-annual periods, I believe at the very least will be a year by the time we get to the end of this year. The management fees, so to speak, have been accrued, so they're payable. They actually haven't been paid. They haven't been paid either in the form of units or cash. So they've been accruing, and as a result, that the sponsor has obviously been supporting the management company in the form of covering operating expenses, including compensation for the entire management team to keep it running and to get us to where we are today. Again, as I define a starting point, to what we need to do over the next 2 to 3 years to increase unit holder value again. So that's my response to your question. In a lot of ways, we've been bearing 100% of the cost, irrespective of whether it's at 50%, 100%, or 150. We've been bearing that cost. So hopefully that clarifies or answers that question directly.
Thanks, Mark, for that clarification. Maybe let's pop over to Trip. Now that we've given you some rest, Trip, share price has been a big concern, big drop. Any view on that moving forward, Trip?
Yeah, I mean, obviously there's a lot of things that play into the unit price, and I think that we've obviously been concerned about the drop in the unit price. Our peers in the same sector have obviously seen pretty dramatic declines in their unit price as well. The unit price is obviously going to be reflective not just of the financials and the financial results of the company, but the sentiment and the confidence behind the investment thesis, as well as what other alternatives are available to investors. And so I think all those things are going to play into the share price. Obviously, similar to what we answered before about trying to focus on the things that are within our control, a big key piece of this is us doing what it takes to win back investor confidence. And that comes from us being able to not only make smart moves here going forward about our capital management strategies, but also adding as much value as we can in the portfolio in the places where we can make those investments, and coming up with a go forward strategy that makes sense for everybody, that's going to provide a long-term stable income. So I think that really it comes down to, and what it boils down to for us, is winning back the confidence of investors. And it's hard for me to sit here on a call like this and give platitudes to say that, oh, we're going to do better, we're going to try harder, we hope. It really comes down to what we can deliver. And I think that, obviously this recapitalization plan is not perfect. It doesn't make everybody happy, but it does give us a path to being able to redeem ourselves a bit in terms of how we perform and what we can execute in our portfolio. And I just think it comes down to that confidence. We have to win back the confidence of our investors to get that share price back up. It's also going to take across the board, though, a difference in expectation of dividend yield on what U.S. office is. I think it's going to be tough for us to overcome. If you look at where we were back 2 years ago, where our dividend yield was below, 7 or 6%. I think that S-REITs across the board now are averaging a dividend yield of higher than 6%. So I think, to go back to the lofty levels of where we were before is going to require more than just us increasing the performance of our properties, but it's also going to take a repricing of that risk by the market. But again, focusing on things that we can control and doing whatever we can to try to win back the confidence of investors. It's going to require a lot more than just talk. It's going to require actually executing this plan and doing better than we have been.
Thanks, Trip. We've got just past 1 o'clock, so I think we can stretch it to latest 1:30. Mark has to leave at 1:30 sharp also. So if it's all right with the panel, we can continue on. Let's move the questions to the EGM on the 14th of December. What if the results don't pass? What's going to be the next move? Maybe Trip and then Caroline can chime in. What if the result don't pass?
Sure.
I will start with the percentage required.
Yeah.
Okay, maybe Wanchen, that's a good question. So just to very high level, the 3 resolutions Trip has already shared, they are interconditional because that is the ask from the lenders, that they want all 3 resolutions to be interconditional. And what we need is a 50% pass, which means that for all votes that comes through, 50% of the votes that comes through must be for, 51% must be for, and that will bring us through the EGM. But if any one of the resolutions are more than 50% against, then the entire recap plan will not go through. So that is based on people who put through the proxy votes, and people who show up on EGM day itself. So in the past, if I may just give a bit more color also to benefit of investors who are with us now. Currently now we have about 65-67% retail, and about 35 or so percent, 33-35% insti. Take away the sponsor stake. So in the past AGM, even the recent one we had in April, usually only about 30% of all unit holders vote. So out of the 1.7 billion units, only about 500 or so million comes through. And out of that, in the past also, I mean, based on historical, more than 95% are through insti votes. So, and in the, before our recap plan, before what we announced, our insti is about 45 to 50%. So today we are about 30 plus, 35% or so. So that is just a high level of how voting patterns are, but which is why we have been urging all investors, to put through your vote, to support the resolution, to help us get through this. And I think from the past week or roadshow that we've been doing, we've met with close to 300 investors, not taking into consideration today's crowd, since 29th of November. We have been talking to the institutional investors, family office, ultra high net worth, PB, trading reps, brokers, analysts, media. And some of you would have also seen that through the bloggers, through the mainstream media, analysts. We have engaged everyone that we can to give a fair and independent view of the transaction or the recap pack, put in different views and thoughts to reach the different audience that we had as a REIT. So hopefully, I think we get that through. But for those investors who hold their shares through the custodian and nominees, the deadline is actually today or tomorrow. So I think for retail, believe it's on the 11th, but please do not wait till then to put through it. So that's a very long answer, but I'll just pass to Trip to talk about what happens if the votes don't go through.
Yeah.
Thanks,
So
Karen.
what happens if the vote doesn't go through? I mean, our first step obviously will be to go back and re-engage with the lenders. And essentially we kind of be starting over. The important thing for us to note here is that, you know, this agreement, again, while doesn't make everybody happy, and actually one of the restructurings, one of the rules of a restructuring is if anybody walks away feeling really happy, then it probably isn't going to be a successful deal, because every party needs to be feeling either some sort of increased risk or some kind of increased, you know, pressure. I think that this agreement is the result of 4 months of daily, nonstop, night and day discussions and negotiations, and was incredibly complex. To Carol's point that she said earlier, just getting here was in some ways, and I'm not, I want to be careful about how I say this, but was an accomplishment in and of itself, because it was difficult to line everybody up. And while I don't want to say on one hand that the banks and the lenders have shared in that, you know, faith that we can make something work here going forward by behind this time, they're also under an immense amount of pressure to reduce their exposure to U.S. office. And at this, you know, while the banks deserve, you know, to be given some credit for the earnestness in with which they negotiated with us, it's very, very clear that a lot of these banks are reducing their exposure to U.S. office and would prefer to be out of that as soon as possible. And so if we have to go back and engage with these lenders in another process and starting from scratch again, I think there's a very real risk that some of the lenders are not going to want to go through that exercise again, especially if it's going to take a similar amount of time. And there's a real risk that the lenders could exercise their remedies. And keeping in mind, it requires unanimous approval of the lenders to be able to restructure this. If any of the banks don't agree, then the default remains. And just given how all of our loans cross default against each other, all it takes is one lender to not to agree with this, and the whole thing breaks down. So to answer your question, our course of action would be to re-engage the lenders. If this doesn't pass, we will re-engage them as best we can and try to negotiate another outcome. But I think that we are of the belief that there's a much higher risk of a positive outcome of a recapitalization plan, and that the risk of the lenders exercising their remedies is much, much higher in that case.
And what's the chances of a liquidation, Trip?
Again, I think given the fact that the lenders, that is really their only recourse to get their money back, if you will. The only recourse that they have at this point is a liquidation of the portfolio to get their funds back.
And what would be the outcome of a liquidation? What would the unit holders get, Mark? Trip?
Yeah, well, if you take a look at the value of our portfolio now, and this is a question we've had quite a few times, it's difficult for us to say, to give you a number of what that liquidation value would be. We have some indications, and you can do some math. The current value, the book value of our portfolio is $1.63 billion. The current value of our debt is just under $1.1 billion. If you have a drop of 37% in that asset value realized, that wipes out the equity. That puts you at your loan balance, at the amount of your debt. If you look at the tranche 1 assets that we've proposed to sell, and the minimum release prices that the lenders have agreed to in terms of that release price, those release prices are roughly 25% below the current book value, which means that the lenders are comfortable that the current market to sell those assets would be at prices in about that range. It's not unrealistic to say that if you were forced into a fire sale position, especially if you were going to try and if the lenders were going to try and sell the portfolio as a bulk sale, that you could recognize, you know, sale discounts or discounts to that book value of greater than that. And so we're getting close to those levels to where you're seeing that the portfolio could be sold at a price that would, match just what the value of the debt is. So again, that 37% decline number is something to keep in mind. If you think the portfolio could be sold right now, liquidated at a 37% discount to book, that would essentially put the unit holders with zero value. And so what we're trying to do is avoid that situation. We do feel like there's upside in a lot of our assets over the next 2 years that we can generate positive returns from where we are right now. But that all goes away if we have to liquidate the portfolio in a distressed situation.
Thanks, Trip, for that. Just a side question for Patrick. There seems to be quite a few questions on FIPS in terms of it being a play in this situation. Would you like to comment on that, Patrick?
Yeah, well, I would just say that from a portfolio perspective, I think it is a massive win for unit holders over the long term to have the portfolio. It's a tranche 3 asset for a reason. It's a modern building constructed 2010. It's got very limited CapEx needs. Its in-place rents are meaningfully below market, such that any new leases we do are going to experience positive rent reversion as existing tenants roll. Examples of that are some of the new leasing that we've been able to do, and we've got a lot of leasing to do at FIPS after our restructure with Carter's, but we're seeing rent reversion north of 20%, sometimes even over 30%. The building's in fantastic condition. It's in Atlanta, which is probably, a leading Sun Belt market, and a borderline, growth gateway market at this point. It's become a really strong market. And so I think net, it's a great asset to have in the portfolio for unit holders over the long term. And I think there's going to be meaningful value creation as we execute business plans there. So I think it's a good asset to leave in the portfolio for strategic and tactical purposes.
Thanks for that, Patrick. It's just past 1:13 right now, so we've got 15 minutes left. What I'd like to do is to close off the session with 15 minutes left. Maybe a comment from each of the panelists. Let's start with Patrick, Robert, Caroline, Trip, and then we end with Mark. What's your Christmas wish for unit holders? Now that Christmas is just about 2 weeks away. What will be your Christmas wish at this situation right now? What we have in front of us, the EGM coming up next week, the financial situation for Manulife REIT, the challenges, the uncertainties, maybe the hope here and there. But maybe you hear from Patrick. What's your Christmas wish for unit holders?
Yeah, of course. My biggest Christmas wish is and before I say that, I'll let everybody, speak their own mind with this their last comment here, last remarks. But, we're aware that it's been a very lengthy journey for unit holders. And, this is a complicated restructuring that's taken time. And, the share price or the unit price is, 5-6 cents. And, people have stuck with us for a long time, and we're very, very sensitive and respectful of that. And so, I understand, or we understand some of, the angst that's out there. And, my Christmas wish is that unit holders understand that this is the first real major stabilization of Must at this point in time, and it puts us in a position to have a stable foundation from which to grow. And it allows us to buy some time to go out and execute what we need to do within the portfolio that I do think will meaningfully lead to long-term unit holder value and success. And so my wish for Santa is that, everyone can just look through some of the emotion that's out there, which I totally understand and empathize with, and just see that this is actually a stabilization mechanism that will allow us to succeed over the long term. So that's my wish from Santa this year.
Thanks, Patrick. And Robert?
Yeah, I mean, pretty much echo what Pat has shared. I mean, we thank the investors for bearing with us. I mean, it is indeed a very complicated process, especially with so many stakeholders involved, sponsors, lenders, and we really hope that like Pat says, this is really only the first step, and the most obvious process is to start trying to sell the non-core assets that might be, potentially a drag for us going forward in terms of income generations and further valuation pressure. That's why we identify the 4 assets in tranche 1 to try to, once the EGM is approved, to expedite the sale process and try to get as much value we can out of these assets. Hopefully in a lower interest rate environment where financing is more available to the buyers to start to kind of look at assets to acquire. So yeah, I mean, bear with us. This is just the first phase. There'll be more to come, and hopefully we're able to stabilize the portfolio going forward, and more good news to share in 2024.
Thanks, Robert. Over to you, Caroline.
Yeah, my Christmas wish from center is the share price will climb up higher and higher and higher. And I think, I mean, saying that, it means that we are also, constantly doing our IR engagement, talking to investors, strategic partners, people who see value at this price, because at this price, I think it's a little bit, it's a little bit oversold. So as share price creeps up, as we are able to continue to instill confidence, it also means that we can deliver a recap plan. It means that actually everything is better, including interest rates tapering. So the whole world must work together with us, I think, to get to a much higher share price. Regulators, SGX, MAS, even our trustee and everyone, including like SIAS, all the investment community, including the lenders, have really been, I would say, very cooperative, if I may, for the last 3-4 months. So really, right now is for us to get center to bring his reindeer here to bring up the share price, and then everyone hopefully have a better new year. Yeah.
Thanks, Caroline. Trip, over to you.
Yeah, I mean, look, first, my Christmas wish for everybody would be, good health, relationships that fill your heart with love, and experiences that bring you laughter and happiness, right? That's my Christmas wish for everybody. Other than that, in terms of the business, my Christmas wish would be that Jerome Powell and the Fed would signal that they're done raising rates and they're going to stabilize the rates at a certain level, and that'll bring the banks back into the market and begin this whole process of healing the markets in the U.S. That would be my Christmas wish.
Thanks, Trip. Mark?
Yep. So I'll maybe frame it a little bit differently. I wish all of you a happy New Year and year-end joy here to 2023. But rather than maybe making a wish for all of you, I'll tell you what we can give as maybe a gift, and it's like just better execution. If all of you can hang in there long enough, and I know you've been very, very patient to date, but to the point of where we can do better, where we can improve with the benefit of hindsight, you will see better, faster execution. It's obviously subject to all the other market conditions, but we're not going to rely on hope or good luck, where we're going to have better risk management as it relates to dealing with some of that bad luck and more difficult, challenging market conditions within our reasonable control. Obviously, the markets do need to loosen up in terms of liquidity to allow us to deal with ultimately what is 2025 and 2026 debt maturities, as opposed to what would have been 2024 maturities beginning in May of next year, if not for this recapitalization and restructuring. So that's what I offer up to everyone, as opposed to just a wish. You'll see better execution from us and the sponsor, and you'll see it done with speed.
Thank you, Mark. In closing, details for the EGM next week. Caroline, there seems to be some question on voting Can they vote in person? Can we vote remotely? Are you able to share any admin details that unit holders need to be aware of before we sign off for today?
Sure. So I think there's questions that, like, if you can't attend physically, then what happens? The notice of EGM and the proxy forms have been mailed to you. But if you don't have it, you can go to the website to download it. You can fill out the proxy form and email it to Boardroom, or you can email it to Manulife US REIT, and we'll put it through. And I think that is also considered as your votes that will come in, which is what most people actually do. So for those who are coming to attend the EGM physically, you can of course cast your votes when you are there with us physically. But for those who are putting in the proxy form, please make sure that your forms get to Boardroom by latest 11th of December. Yeah.
Thank you, Caroline. We got 9 more minutes to end. As we said, hard stop at 1:30. Mark has to go off. Any last remarks from any panelists that you'd like to add?
I think, first of all, I just want to really once again thank you, SIAS, for doing this for many decades, taking care of the minority holders, the retail investors, giving them a forum to be heard and to be addressed. And I want to thank you on behalf of the management team and the sponsor and also the board, to all the unit holders who have been with us through this very difficult journey. We are doing our best and what we can to get to the next step. Life may not be fair, things may not be in the best that we hope for, but what we can assure you is we are doing all that we can and doing what is best for unit holders. Even though it may seem a bit difficult or I think challenging to believe, we hope that unit holders will be able to support the upcoming EGM and give us a chance, give the sponsor a chance to also execute. End of the day, it's talk amounts to nothing, right? It's the action that we need to put through. So give us a chance to put that into action, and hope to see all of you at the EGM, for those of you that can make it, and do come up to say hi if you do, and wishing all of you a great Christmas, end of the year, and hopefully 2024 will be a better year for everybody, including all the REIT holders out there, because it is challenging times for REITs in general, with REITs been creeping up. Yeah, and thank you, Wan Chen, for hosting this, and your team, and all the hard work that you have done. Yeah.
Thank you. And on that note, thank you, panelists from Manulife REIT, Mark, Trip, Caroline, Robert, and Patrick. And we hope to see all unit holders at the EGM next week on the 14th of December. And on behalf of SIAS, thank you very much.
Thank you.
Thank you.
Thanks, everybody.
Thank you.
Good day.
Thank you.